Hello, clients and friends. This is Tim Brown from Brown Wealth Management, and it's my pleasure to present our fourth quarter economic review and 2023 outlook. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. After a healthy year for investors in 2021, on January 2nd of 2022, the first trading day of the year, as this headline shows, the equity markets made new highs. While almost all analysts called for that trend to continue, sadly, after that, the rest of the year was turbulent and painful for investors. While almost all analysts called for that trend to continue, sadly, after that, the rest of the year was turbulent and painful for investors. Seasoned investors understand that equities are long-term investments and market declines are part of the investment experience, the same way traffic jams are part of the driving experience. As unwelcomed as it was, 2022 was a year of disappointment. Perhaps the best part of 2022 for investors was that it ended. Now let's briefly recap some of the events from 2022 and then turn our focus on 2023. As we look back at why 2022 was so challenging, here are some of the major contributors. High inflation, rising interest rates, slowing economic growth, and the weakening of physical and monetary stimulus, and continued global concerns all factored in to the continued volatility and uncertainty in equity markets. As we stated earlier, after enjoying the longest bull market in history from after the financial crisis in 2009 to the beginning of the COVID-19 pandemic, the bear finally rose from its slumber and dominated Wall Street. In fact, 2022 was the worst year since 2008 for all three major indices. 2022 was a roller coaster of a ride that included several ups and downs. But equity markets overall experienced a consistent downward trend. Even a strong fourth quarter where the S&P was up over 7% and the Dow Jones Industrial Average was up over 15% in the fourth quarter, you couldn't bail out the rough year-end results. The broad-based S&P 500 finished the year down 19.4%. As we closed out what was undoubtedly a rough year for equity markets, investors were emotionally preparing for another potentially mercurial year. On a positive front, the Fed's efforts in raising interest rates to slow down the rate of inflation finally began to show quantifiable results. The U.S. annual inflation rate experienced a slowing down in November and was at 7.1% for the 12-month period. This is 2 percentage points down from the June high of 9.1%. While progress is being made to reduce the rate of inflation, Americans continue to feel the pinch of inflation. Expenses increased across the board in 2022 from housing, gas, transportation, food, and everything in between. In 2022, Americans saw 7 federal interest rate increases, ending the historically low interest rates that were enjoyed since the Great Recession from 2007 to 2009. In their efforts to get closer to their 2% inflation rate objective, the Fed raised interest rates twice in the fourth quarter of 2022. In November, rates increased 0.75% for a target rate range of 3.75% to 4%. Not surprisingly, the Fed again raised rates at the December meeting. However, because inflation began to slow down in the months prior, the Fed raised it by only 50 basis points for a target rate range of 4.25% to 4.5%. This marked a 4.25% total rate increase in 2022, the fastest upward cycle in history. It is anticipated that the federal funds rate will continue to rise in 2023. The Fed is watching key economic indicators, including the unemployment rate, personal consumption expenditures, and the consumer price index, until they see substantially more evidence to give confidence that inflation is on a sustained downward path. The Fed will continue its fight to quell inflation. We will keep a vigilant eye on the federal interest rate movements and inflation. When rates will stagnate and for how long they will remain there is yet to be seen. As you know, bonds and interest rates move in the opposite direction. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Bonds are many times considered to be more stable than equities for an investor. However, there's no doubt that bonds had a terrible year in 2022. The 30-year U.S. Treasury bond saw its worst return in a century at a minus 35%. As of December 30th, 2022, 5-year Treasury notes yielded 3.99%. 10-year notes yielded 3.88%. 20-year notes yielded 4.14%. And 30-year notes reached 3.97%. The 1-year Treasury rate reached 4.73% on December 30th, after a fourth quarter high of 4.8% on November 7th. Many experts expect that since we now have an inverted yield curve, where short-term rates are higher than some long-term rates, that this is indicative of a recession. However, if, when, and how severe a recession should occur in 2023 is all still speculation. Our goal as your financial professional is to not try to predict the future, but provide you with a solid financial plan that is designed to best weather any market environment. If you'd like to explore how bonds could fit into your retirement income strategy, please contact us so we can help you make the best decision for your portfolio. Safety comes with a cost. Have you seen what interest rates banks are currently offering savers? According to Barron's, the average bank money market rates on December 26, 2022 were 0.25%, and the average 12-month CD rate was 1.35%. While higher than a year ago, these are still pretty slim returns and difficult to achieve your retirement goals with. As we enter 2023, we stand by our mantra of proceed with caution. Multiple factors remain key players in the direction of equity markets, most particularly the continuation of interest rates and speculation of if, how long, and how deep a recession in the U.S. and global economy could see in 2023 and beyond. Global unrest, including the continuation of the Russia-Ukraine war and the slower than desired reopening of China after their zero COVID policy was lifted, also factor into uncertainty in 2023. As your financial professional, we are committed to keeping you appraised of any changes and activity that could directly affect you and your unique situation. What should investors be looking at in 2023? Expect more interest rate hikes. The cost of borrowing has increased. We suggest that you proactively pay off all non-essential interest-bearing debt and maintain liquidity for short-term purchases. Review all income-producing investments. And as uncertainty remains, remember, a well-balanced portfolio should be designed to have resilience in times of volatility. This is an ideal time to practice patience and to remain focused on your personal long-term goals. Talk of a possible recession remains front and center. Many analysts fear the Fed's interest rate hikes to fight inflation at the expense of economic growth is driving the U.S. into an inevitable recession. However, the Federal Open Market Committee projected economic growth of 0.5% in 2023. Albeit small, it is still growth. While we can all try to foresee the future, no one can predict the length or severity of any recession. However, while past performance is not a guarantee of current or future results, history shows us that equity returns after recession have been fruitful. As a recap, here are some things to remember. The current bear market looks like it could continue. Just remember that bear markets are part of the investing experience. How long this bear market will last is yet to be seen. Interest rates are still on the rise. Refocusing and revamping your budget now could provide direction and clarity on where your money is going, what is a necessary expense, and what is discretionary in this new year. Having a solid investment strategy is an integral part of a well-devised, holistic financial plan. We help clients create a well-crafted plan customized for their unique situation and goals that takes into consideration how each client will react to the ups and downs. We consider many variables, including your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. Caution should still be the principal notion for investors. Again, we feel the best strategy is to stay the course and focus on long-term investing strategies. And as always, we are here for you. As stewards of your wealth, we are here to help you pursue your goals. If you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting. We are very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. We look forward to serving you in 2023. This year, one of our goals is to help more people just like you. The best compliment is a referral. Some of our best clients were referred to us by existing clients. If you know someone you think may benefit from our services, we would appreciate their contact information so we can add them to our distribution list to receive our newsletter and so that we can invite them to attend our presentations. Again, thank you for your business. One of our primary goals is to keep our clients informed, and we appreciate you watching our updates. Please call us if you have any questions.